Across the US, millions of people trust self-storage every day, and now it can power your investments to accelerate wealth growth. Hearthfire's dual return advantage makes self-storage a double engine, delivering monthly cash flow today while building long-term equity growth for tomorrow.
This is the premier investment strategy that blends both passive income and cash flow with some equity potential in private credit. Private credit is one of the premier investment strategies that has emerged over the last several years.
It is Thursday, October 2nd, 1 p.m. Eastern Time, and Hearthfire Holdings welcomes you. Today, we're diving into the dual return investment advantage, a strategy that's gaining momentum with investors who value both predictable cash flow they can count on today and equity growth to build wealth for tomorrow. During this session, we'll also walk through live projections and real-world scenarios to help you plan ahead and stay ahead. Welcome.
Okay, so let's jump into the presentation. First, we're going to start with a little bit of a disclaimer. So this presentation is for informational purposes only, and this is not advice or an offer to sell securities. That's only done through our legal process and subscription booklet, which would be available should you be interested in pursuing an investment. Please keep the information confidential. You're welcome to share referrals, but the materials being presented here should not be freely circulated online. Market information and various information and data points is obtained by from third parties. We are not independently validating all of their sources. Projections should be considered hypothetical and based on estimates and assumptions and not guaranteed of actual returns. Keep that in mind as you're evaluating this, and the actual investment returns may differ from projections due to the alternative investment space and some of the forecasting that is done related to these investments. So just real quick, we're going to be covering a little bit high-level overview of our company background for those of you that are new to Hearthfire. We're kind of going to blast through all of that. I'm going to share another video that was prepared by Haven Chavis, our business intelligence and data architect, put together some of our calculators that basically enable some of these advanced investment strategies. And what I want to share with you today is that we're going to be talking about private credit as an investment strategy, and specifically with us, our Hearthfire Income Fund, but also how it's paired with our common equity investments, and specifically in our Whitehall and Taylor investments, which are the last two or most recent investment opportunities we've had. And the private credit, or the Hearthfire Income Fund, was born as an opportunity for us to take advantage of the current higher interest rate environment over the last few years to be able to provide a cash flow investment vehicle tied to self-storage. We've been pairing that with our Taylor and Whitehall investments because those investments on their own are long-term growth investments and not intended for early cash flow. There are many other investment opportunities out there that tend to offer both. However, some of those are structured with a reserve built in to where they're servicing the early cash flow from literally investor dollars. So this is our answer to be able to provide the best of both worlds. They are separate investments that combine to make a strategy. So we believe that it is the best opportunity out there with regard to early cash flow, as well as equity growth potential, and hope you find that to be the case as well. It has been very popular with our last two investments. Therefore, we think you will enjoy it if you're not already participating in it. A little bit about our company and our leadership team. So Corinne and I started our company back in 2012 together from personal investment endeavor. Everything that we've done or what we offer to our investors, we've done personally ourselves. So really everything is born from a tried and true, let's evaluate, and then let's offer that to our investors. along the way, we've been building a team of industry experts that really have helped amplify and grow our expertise in being able to offer the best in self-storage investment opportunities. Here you see our leadership team of Mike Marin, our CFO, Pete McDaniel, our Chief Development Officer, and Jeff White, our Director of Acquisitions and Portfolio Management. Combined, we have over 350 active investors that are made up of independent family office institutional investors, over 50 million in equity under management. Through all of our investments, we've distributed over $6 million, not including exits, and a 25% internal rate of return across all of our exits, which include multifamily and self-storage. My background, worked 30 plus years for the 22 years within the Federal Reserve, 30 plus years across finance, real estate, and technology, which is my background. All of that has combined to help us create this scalable investment platform. Corinne can tell you a little bit about herself. I'm not going to do that.
Well, I'm a second generation entrepreneur. Grew up with my very first exposure to real estate, thanks to my parents and being the sidekick for my mother, hands-on actively managing our small residential portfolio. Pivoted into working for the Fed in project management, which is where Sergio and I met, and embarked upon our first few real estate investments. And here we are, just about 13 years later.
So I won't go into great detail of our core team. What you can learn about them is they are made up of real estate, private equity, and self-storage true experts. Mike Marin has 25 plus years in institutional investment, finance. He also leads our capital markets function. If you listen to some of our recent webinars on the Taylor investment, he's responsible for identifying and building out that fantastic financing structure. Pete McDaniel, who's not only serving as our Chief Development Officer, but also as our interim COO and helping build out all of our scalable processes that continue to evolve as we've grown and get more sophisticated. He's got 20 plus years in construction, developing everything from courthouses to self-storage, and most recently was with Extra Space. With Hearthfire, we've delivered 7 construction and expansion projects as a team over the last year. In the construction world, that's true scale. We're super excited about all of the potential that we have with regard to development and everything in between. Jeff White, he recently served as Director of Acquisitions with CubeSmart, one of the top few REITs in the nation for self-storage. He's got 25 plus years of commercial real estate and sourcing, underwriting, and asset management. He manages our acquisitions team as well as asset and portfolio management to make sure that our business plans are going as planned. Here's a little bit about our history. So we're very proud that it's been a strong methodical growth. There's been a lot of other platforms out there that have kind of grown, exploded overnight through really fantastic marketing and really being able to raise a lot of capital very quickly. Our growth really started with friends and family and multifamily and acquiring small properties in and around Philadelphia. We pivoted to self-storage when we had the foresight to know that it was an overcrowded industry. If you're following commercial real estate today, you can recognize that there's a fair amount of distress with underwater properties, especially in multifamily. We're very proud that we exited that sector, did fantastic for all of our investors, and we got into self-storage at a really strong inflection point for the industry. We're very excited about where self-storage is headed for a few different reasons. Number one is it is a dynamic business that is based on a subscription model of service. It is a dynamic service that expands and contracts or provides services that parallel life expansion and contraction, economic cycles, so on and so forth. And it's a very data-driven industry. Coming from IT and with our data background, that's huge because as you layer in technology like AI, you're able to identify the patterns and foresight to be able to understand how these assets are behaving and adjust dynamically on the fly. So this is why we have a lot of conviction in our industry. We're not going to dive in deep in all the beauties of self-storage today. We have a white paper on our website that really goes into a lot of our investment thesis in self-storage. Here we are today with over 20 assets, combined 200 million in stabilized value, over 5,000 units, approaching a million in net rentable square feet upon some of these construction and expansion projects being completed. We have a self-storage exit under our belt where we delivered some really impressive returns. I'm not going to mention the numbers because those returns are really not common in the industry, period, but these days especially. Here is a glimpse of our current portfolio. You can see it's a diverse set of assets in various markets. We like to identify markets that we think have some disproportionate level of growth potential as it relates to national averages. We like to plant a flag with an initial investment and then grow and expand our portfolio from there. So you can see that we have quite a bit of expertise and a portfolio that continues to grow and scale. One of the proudest elements of our company, and something that we work really hard on, knowing that we are an industry that is subject to a lot of economic, market, and factors that are not directly in our control, we focus on what matters most, and that is communication and transparency, deal access and quality, operational execution, and investor value alignment. The results you see on screen here are from a recent survey that we had excellent participation from our investor community, and we scored communication and transparency 8.9 out of 10. And then you can see the great scores that we received. So this is a recent survey, and this is really what we work really hard at.
And it speaks to our beginnings of as starting by serving our own direct family, and then spreading out to close friends. And we've really kept that as the foundation upon how we operate and how we function. I see some names here joining today where we've had direct conversations or you're in direct text communication with me. So we try to hold true to that and really acknowledge that we are working with you, other human beings, and trying to serve your families and your investing goals. So keeping the human element.
Here's just some testimonials, and really our 90% reinvestment rate is really coming down to our exits across multifamily and self-storage, and that's the number of investors that have stayed with us over the years and have done very well. And the testimonials really are some of the unsolicited comments that we received. So I'm going to jump into the private credit and hybrid equity investment portion of the presentation. As a reminder, this is being recorded, so if you have to drop, totally understand. As we do that, I'm going to share a quick video. Thank you to Haven, who has joined us, and he's going to share a little bit that kind of give you a really quick glimpse into what we're going to cover next.
Hi, I'm Haven Chavis, Senior Business Intelligence Architect with Hearthfire Holdings. Today, I'll walk you through our web-optimized projection resources, which help investors easily visualize projections and better understand potential outcomes across different investment opportunities. Our team has developed proprietary web-optimized projection resources, custom-built analytical tools that exist nowhere else in the industry. These aren't spreadsheets or generic financial calculators. This is institutional-grade technology, built in-house by our experts, designed specifically to model and optimize your investment outcomes. Our web-optimized projection resources allow you to model complex investment strategies in real time, visualize your returns across multiple scenarios, optimize allocations based on your specific goals, and access institutional level analysis from anywhere. What if you could double your money in 5 years while still receiving monthly income along the way? The HIF Taylor Hybrid Strategy, powered by Hearthfire's proprietary technology, will deliver steady cash flow and explosive growth potential. Most investors face an impossible choice: accept low single-digit returns from bonds and CDs, risk potentially everything in a volatile stock market, or lock up capital for years with no access to cash. But what if there was another way? The HIF Taylor Hybrid Strategy delivers exceptional double-digit annual returns by combining two powerful investment vehicles:
the Hearthfire Income Fund and the Taylor Equity Investment. Together, they create the perfect investment balance.
Let's look at this scenario. An investment of $200,000 balanced 50-50 across HIF and Taylor with $100,000 in each component yields total returns of over $200,000 for a final value of just over $400,000. This creates a blended annual return of over 20%. While traditional investments struggle to keep pace with inflation, you're building real wealth. But here's what makes this truly special. Unlike other high-growth investments that lock up your money for years, the HIF component delivers a monthly cash flow from day one. We can see in the HIF component, the investor will receive just over $10,000 in year one, $11,000 in year two, and $12,000 in year three, plus the return of their $100,000 investment. Additionally, the Taylor component produces smaller returns in year three, slightly higher returns in year four, and then a massive payout in year five. Now, within this calculator, every investor is unique. That's why you control the mix and see the impact instantly. If you perform more income, shift more funds towards the HIF component and watch your cash flow projections update in real time. Conversely, if we contribute 30% of our investment to HIF and 70% to Taylor, we're choosing maximum growth. But naturally, a 50-50 approach is the most balanced. The hybrid structure provides diversification across two distinct strategies. It provides structured returns and not market speculation. You're not gambling, you're strategically building wealth.
All right, thank you for that, Haven. So a little bit about the calculator there is, that was kind of a brainchild of mine where as we were trying to put together this model, it really became, how do we make sense of it to show two separate investments and how the returns blend? So it became a spreadsheet that was built over time. And as we started to introduce the concept and share with investors and go through the modeling, it grew into the opportunity to kind of make it a more dynamic calculator so our team can use it. So as it stands right now, the calculator is something that we use personal to kind of customize investment strategies. We'll talk a little bit more about that. But I'm going to turn our attention to the private credit industry and how that has evolved and grown. There is a white paper that we've produced on private credit and where that fits into the alternative investment space. So I encourage you to visit our website to access that. But we're going to talk about a little bit of where that fits in right now. So the current problem that we see it is where traditional markets fall short is really comes down to a few different areas. One is inflation erosion. Persistent inflation has always and will continue to diminish real world returns. Even if you look at the S&P 500 over the historical average returns, if you factor in inflation, it's really in the single digits. So really, my philosophy has always been that between your income and investment strategies, if your wealth is not growing by 10% per year, you're actually eroding your investment or income potential. The equity market is very volatile. Yes, we are at all-time highs. Depending on who you follow in the industry, you will hear that the PE ratios and a lot of the market fundamentals are so way out of whack that it's not sustainable. There's a lot of talk, even within our office, that the returns that we've been seeing over the last few years may very well not be that longer term. If you listen to somebody like Ray Dalio, who I respect, have a great deal of respect for, they believe that there is a bubble there. And again, what we're talking about here is not a wholesale shift, but we're talking about a diversification play here. You will never hear me say, hey, I want you to completely exit the stock market and join what we do. That will never be the case. It would really be about consider your own personal investment portfolio and allocations and how you split your pie to really create the balance that makes sense for you. Fixed income constraints, bonds offer stability, but yields rarely outpace inflation. Over these last few years, with interest rates having shot up very quickly in a short period of time, there has been a higher yield in bonds. That has also created the opportunity in private credit, and we'll talk a little bit more about how that has come to fruition as the Fed has started to cut rates and continue to watch that, expect that those yields to come down a little bit. And the yield gap, traditional portfolios are struggling to deliver consistent inflation-adjusted income. Again, we've been seeing an overabundant and growth-oriented market. How long that's sustainable, time will tell. The private credit industry has gone from a niche strategy to an institutional mainstay. Private credit has grown to a $1.7 trillion global market over recent years. It's been historically reserved for large institutions and has been made available to accredited investors. And how that's come to fruition is really a lot of the opening up the alternative investment space, which goes back over the last 10 to 15 years. And then really the true understanding from a legal taxation and making it available as real world investable and directly be able to access these types of strategies. And really it's positioned between equity risk and fixed income yield. And we'll talk a little bit more about that as well. So the history, a little bit of the history going back to 2008, banks really tightened their lending platforms and kind of left a void in the middle market between senior financing and common equity investments. In early 2010s through 2019 or so, private credit began expanding and expanded steadily, primarily used in pensions and endowments. Still resilient, but niche in, was stable in the low rate environment, still outpacing bond yields and so on and so forth, but still limited investor access. Fast forward to the rate hikes, and started in 2022, and it really began to push yields to generational highs, and that has maintained, because even though interest rates have come down nominally, there still is that gap between where banks are lending and where the markets are really needing in terms of demand. So now it is mainstream and accessible, and accredited investors are now realizing 7 to 11% yields, and that's in preferred returns. There are some platforms that are offering even greater upsides. Here is just a little bit more about the size of the market to give you the idea of how it has grown exponentially over time. And the charts, if you look going forward, continue to grow disproportionate to the other industry. What's important to consider is that not all private credit platforms are the same. Ours is focused, as you might guess, 100% on self-storage. Self-storage is considered the lowest risk real estate investment asset, and it's primarily because it's very low, very wide margins. Typically, you're looking at 65% profit margins. It is a dynamic business with a real estate component, hence why it has been a preferred asset class. We're applying private credit strictly to self-storage. There are plenty of private credit platforms out there that are, focused on fix and flip loans, distress situations, et cetera, et cetera. The nice thing about all private credit funds are that they are diversified. You are typically going to invest in a pooled fund, and so the diversification really does matter. Ours is no different from there. You do have the higher yields. As I mentioned, the 7 to 11% is what we are offering to our investors. And obviously, this is outpacing traditional fixed income, which is usually about 4 to 6%. It is asset backed, meaning that the loans and preferred equity investments that are being made are collateralized, in our case, by self-storage real estate and then personal guarantees. The downside protection is through the hard collateral. And it is a diversification play when compared to, say, public equities, bonds, and even common equity investments. We'll talk a little bit more about the dual return strategy. And the dual return strategy is really the cash flow and hybrid equity investment. And as I mentioned earlier, the opportunity here, how we've designed it, is actually two separate investments in separate vehicles, not combined. So that gives you a good downside protection as it relates to the risk associated. So private credit and preferred equity is really just a direct investment in an individual offering, whereas the private credit in our case is a fund. If that is not something you fully understand, feel free to ask questions, but we'll hopefully by the end of this, that'll all be clear. So with our dual return strategy, we're offering 9 to 11% current cash flow yields, and that's because we're giving enhanced returns on our income fund portion, starting with the Class B investment strategy or investment option, and it goes up to 11% rate of return. The minimum investment that you will see is $100,000. You see $50,000 on screen there, but that is per portion of the investment. So the income fund portion and then the common equity investment. As I mentioned, self-storage continues to be resilient. We have strong demand, low supply nationally, and it's got insulation components versus inflation and downturns. The dual return strategy is intended to combine current income and long-term equity upside with the tax advantages. The tax advantages really come into play with the depreciation that come from the common equity investment portion that offsets the passive income that you get from the cash flow component. Separate investments, as I mentioned, provides dual yield, but the risks of each portion is isolated. We say that it is a limited window opportunity merely because it is correlated to the rate cycle, market fundamentals, and regulatory trends, which suggest the rates and spreads might compress soon. You'll see on screen a link. Kateri will be sharing various links throughout. They are to get you direct access to some of the more details around these strategies. Let's talk a little bit about the Hearthfire Income Fund. This is our flagship private credit fund. This is leveraging the growth of private credit and the resilience of self-storage to deliver cash flow investment strategies, higher yield returns, capital preservation, flexible terms, tax advantages, and an equity conversion option, which is embedded within this. There are three classes of investment in our income fund, traditionally or separately, I should say, which is Class A, which is a minimum investment of $200,000. It yields 10% rate of return, 2-year minimum investment. Class B, $100,000 minimum investment, 8.5 annual percentage rate. Minimum commitment period is 1 year. And then Class C, which is the balance or yield and liquidity, minimum of $50,000, 7% rate of return, or a 6% or a 6-month lockup. When we talk about the dual returns, we're going to talk about some tweaks to the Class A and Class B investment portions here. And what you see on the right is really the compound growth. The compounding option for the income fund is limited to an independent investment in the income fund. That means that your yield and your dividend or preferred return just remains in the income fund and continue to compound. The dual return strategy. So this is an innovation that we've come up with when we were talking to investors, and we're considering how do we offer current cash flow as well as equity growth. And it's not easy to do with value add or development investments, obviously, because there's no cash flow while we're executing on the business plan. So it has been designed mirroring a lot of institutional caliber type of strategies. As I mentioned, it's a hybrid private credit with equity potential. The yields are 9 to 11% current, meaning that monthly annualized rate of return, and the equity upside on the common equity portion of the investment. I mentioned the tax advantages, which includes bonus depreciation that offsets the income. It is 1031 exchange eligible on the common equity investment, and self-directed and solo 401k eligible for both portions of the investment. Here is kind of a model side by side. On the left-hand side, you see just an isolated equity and growth investment in our Motor City Rebirth, also known as Taylor investment, which we are down to the final few shares, a $200,000 investment. You see that the cash flow begins in year 3, year 4, with the final payout, as Haven showed in the video earlier, for an internal rate of return of 22%, an average annual return of over 30%. If you go all the way to the right-hand side, this is a $200,000 investment only in the income fund, which is generating a 10% rate of return, which would get you 20% or $20,000 per year, with the 2-year commitment, and then your initial capital returned at the end of your commitment period. The rate of return down there at the bottom implies the dual return strategy, hence why there's an error there with the numbers. When you look at the dual investment, this is modeling a $100,000 investment in our Taylor project, as well as $100,000 in the Hearthfire Income Fund, for a combined $200,000. Here you see the cash flows of $11,000, and these are rounded numbers, not factoring in calendar days, et cetera, placements, so on and so forth. $11,000 year 1, $11,000 year 2. And because it is a 3-year commitment, when combined with our Taylor project, you would get your initial $100,000 back, plus the accrued return in year 3 from the cash flow of the Taylor project, as well as the income fund, for a combined $116,000. Year 4, you are now getting the cash flow from the Taylor portion of the investment for a total return of $254,000. You see the blended return down at the bottom. The 4% total return is kind of the haircut for getting the cash flow up front. Going back to the calculator, this is a model that shows you how the investment performs when split between both investments. We have this calculator available right now. It is for our investor relations team to work with you to kind of model this. This is where we can get into some of those. How do you split the investment? proportionately depending on what your goals are, investment strategy, and then the allocations will dynamically change based on that. From a Taylor, Michigan project perspective, or a Motor City Rebirth, if this is your first exposure to this, Kateri shared the link to the full details of that project, including videos from all of our previous webinars. The goal of this conversation is not to go into great detail there, but what we can tell you is that is a common equity investment. The business plan is that we will be closing in the next several weeks on a newly developed Class A self-storage property in Taylor, Michigan. It will be managed by Extra Space Storage. It is a severely underserved market with strong demand from residents and small businesses. It's got a competitive advantage within the market, with Extra Space being our manager, as modern, as cutting edge as you can get from a self-storage facility, complete with indoor loading and unloading. Fantastic for the climate of the Michigan market. The financial outlook is 92% square foot occupancy within 3 years, and then financial break even within 18 months, and then reaching our exit potential and peak performance in year 4 with an exit in year 5. Here is a hybrid model with our Whitehall. This one has got a wait list right now open. If you wanted to get in this is a project that's actively under construction in the Lehigh Valley. The Whitehall project has really been fantastic. We are beyond our heightened risk time with that project, meaning that we've done all the excavation. We're now building foundation. So the heaviest risk of that project has been passed.
I will say the key differences between Whitehall and Taylor, fundamentally, I speak with some investors that maybe you're local to Philadelphia area, you love the idea of investing in the Lehigh Valley, or maybe you're more local to Detroit and you want to be investing in your backyard there. So geography is obviously the key differentiators there. And also, if you are looking for tax losses, Taylor, Michigan, or the Motor City Rebirth project will deliver losses this year in 2025, while Whitehall, Pennsylvania will deliver losses next year in 2026. So those are some key things to keep in mind if you're really looking for those tax losses for your end of year financial planning.
Yeah, and
Trying to cut in.
The other part of it is the construction element to it. They are different markets, so there's some dynamics that are really personal preference in terms of perceived risk and actual risk, so on and so forth. So both of those projects are super exciting when paired with our dual return strategy. Really offer a really compelling opportunity there. The tax efficiency really here is when you're looking at a cash flow or passive income investment without some level of passive losses, that's just going to inflate your income, and which would result in potentially higher current taxes. When paired with our common equity investment, those passive losses offset that passive income. That's why it's a really popular investment strategy. So the portfolio fit, it's really just about, we say that really where this comes into play in this investment strategy is if you're ready, willing, and interested in investing today, then it's a matter of, are you interested in growth, or are you interested in self-storage? If you're interested in self-storage, then it's really about income, growth potential, or the combination thereof. I got another poll for you, and this is...
Oh, yes, and thanks. So Kateri's also popped up a link. This is quick 15-minute call. So really, if there's just any burning questions that you want to get answered short, in a short, direct conversation, that link that Kateri just recently popped up is for that.
All right, one more final question. There are some polls that are going up now. And really, this is an opportunity to ask questions. I know we covered a lot of ground. This is we are customizing strategies here. That is kind of the way that we are modeling this. Not every investment is suited every which way for everyone. So we like the opportunity to kind of partner together and create something custom.
And maybe let me just recap, because we did talk about the fund as a standalone investment and the 3 classes of shares there and the investment minimum and the time commitment there. The key differentiators, if you're considering the dual return, is that the minimum, so for a 50,000 minimum in the dual return into the fund as part of a dual return, the 50,000 minimum is a 2-year commitment, and that's delivering a 9% annual return, which is quite a large step up from if you were to put that same 50,000 directly into the fund. That's a 6-month commitment, 7% return. So that's the main difference there.
Yeah.
If you were to do 100,000 allocated to the fund in a dual return strategy investment, that's 11% and a 3-year commitment. So that's the biggest. The enhanced returns there is the biggest.
On the Taylor page, I believe we have the detailed breakdown. Thank you for that.
Yep.
That's kind of a miss in the deck to just
summarize.
not have the enhanced returns. So you could think about it as the minimums, Class A and Class B, cut in half, with the enhanced returns being a half a point and a full percentage for the Class A and Class B investments. So that completes what we had wanted to present.
Please don't be shy. Pop
Yeah, if you have any
into the
questions,
chat.
I can go through some of the common questions we are asked. How often are the distributions processed? They are processed monthly. The compounding is not an option when you're choosing the dual return strategy, because we are emphasizing the cash flow and the way that the nature of the fund is structured. We manage our target preferred return. So therefore, it's important that we provide the cash flow. So there are monthly distributions. The Hearthfire Income Fund is total fund value is about $7 million now. It is diversified in preferred equity, various mezzanine financing, and we have a very strong cash position right now. There are and the Taylor project, we are scheduled to close over the next couple of weeks.
Yes, I will say, if you are at all interested in Taylor, we're down to our final 200,000 available shares.
Yeah.
And then from there, we'll start developing a wait list and might be able to add more folks if any of our current committed investors, for whatever reason, drop out. But we're down to the final 200,000. So would encourage you to let us know soon if that's a priority for you. I'm seeing.
Yeah. I can handle some of these. So question came in. Thank you, Kamlesh. Never did a self-directed IRA. Not sure how to get more information on that, how to use self-storage to invest in with Hearthfire. So we have a significant number of investors that have used self-directed or solo 401ks to invest. So simply, there are a number of or I want to call them partners.
I would say the ones that we see most often, and I can certainly send direct introductions to my points of contact, but we see Equity Trust is a large firm in this space, as well as Rocket Dollar, as well as Gamma Plan.
What we can do, Kamlesh, we'll reach out to you personally, but we have I believe we have a link on our website for our self-directed IRA partners.
I'll be sure to follow up with you directly and make some introductions.
Next question is, will dual return be available in future project? So the short answer is, that is the intent. The income fund is really available today based on current market environment. What that means is as interest rates come down, if the private credit market or the interest rates come down and the ability to place large portions of capital is not available, then we have to throttle the income fund and our ability to accept new investors. So if you are interested, I'd act now. We have done it for the last 2 investments. As long as the environment is available, then we will most certainly do that. But our intention is to grow the income fund, so we are planning on to offering it down the road. But again, some of the returns and yields might change. How do we choose what areas to invest and what is the criteria? So we have a very well-defined buy box. What that means is that we look for expanding and growing markets as it relates to self-storage demand or economic or fundamentals that suggest self-storage is the right product for the market. National average is 8.5 square foot per capita as the balance between where supply and demand meet. We look for markets that are undersupplied, but also that have strong population within the 3-mile radius of any potential site. 3-mile market is generally the predominant client base for self-storage. So that is where we are laser focused. We evaluate what are the rates being charged in that market. Those are significant. We look at renter population, we look at median household income, et cetera, et cetera. So we look at primarily secondary markets. Primary markets are usually dominated by the very large players with a much lower cost of capital. They don't look for the yields that we look for. They're a lower yield investor. And then from there, it's really just a matter of laser focusing on the fundamentals of the market.
Yeah, densely populated areas, renter population. I'll call out Whitehall, for example, very dense area, and it's a 52% renter occupancy there, and that really drives storage utilization. So those are some other key data points that we look for in any submarket that we're in.
Okay.